Hello, inflation debate and the rest. Sorry. So we should be beginning right now. Hello. Hope you're ready. So today's class will continue with what we did last time. We did the oscillators, and today I'll be on gold. Gold has been doing fairly good or fairly bad, ups and downs. So let me share my screen so that we get started. Okay, here we are. Yeah, so here we are, and also have my chart ready. No, this is Euro USD. And also have my gold chart ready. So today I'll also introduce you a little bit on just a minute. This machine. So give me a minute. Okay, let's get started. So today's mostly I'll do divergence. I won't go much more than. So I wanted to do 3 things: environment and breakouts. But because of time, I'll just touch on divergence today, and then I'll also give me a minute. Yeah, here is trading divergence. So this one I'll have to leave it for today. So I'll also introduce you to Fibonacci. So I'll combine mostly divergence so that we are able to know when to get in and when to get out. So let me do that with Fibonacci. So just a minute. Before we go to divergence, we need to also have, this is high school. So, and I'm also going to do more of a practical session. So theory might be 5-10 minutes. Then I go to the practical session. So pay attention. So let me start with Fibonacci, because we never touched Fibonacci. I'm going just to introduce what it is. And then I'm going to combine 2 moving averages, SMA and SMA. You see, this is my chart. So you can see I have 2 moving average. This is 20 and this is 14. Then I have a wedge here and I have the Fibo and I have the oscillator. So down here on the oscillator, I'll be just adding now the divergence, maybe stochastic, combine it with RSI. So that way we are able to know our regular or our hidden. Is the market changing? Changing means, is it reversing or is it continuing with that trend? So let's start with Fibonacci. Fibonacci is just ratios. So I also have my chart ready. So today I'll do more of practical. So I'll have to put you there. So this is my fibs on H4 on gold. So I'll be using this chart so that I can show you falling and rising markets. It's what we did on the last class. So I hope you can hear me. So pay a lot of attention because we'll be doing a lot of analysis on gold. So let me first touch on Fibonacci, what it is, the ratios. Do I have charge? I have charge. What the ratios stand for. And then apart from that, I'll combine it with divergence. Divergence is very important. It's one of my best tools in technical analysis, because when I combine divergence with Fibonacci, I'm able to get my reversals. So kindly mute your speaker so that we can get started. So we'll be using Fibonacci ratios in our trading so you can better learn it and love it like your mother's home cooking. So Fibonacci is a widely subject. It's usually applied in so many things, from physics to nature to everything, but we also apply it to trading. So let us first introduce the guy himself. This is called Leonardo Fibonacci. We need to see him. So just a minute. So Leonardo isn't some famous chef. He was actually some Italian mathematician. So this guy was very idle when he was able to come up with whatever we are about to learn today. So let me show you the guy. He's called Leonardo. This guy, yeah, he was an Italian mathematician. So let's just have a look at him. Leonardo of Pisa. Yeah, I just want you to see the images. Yeah, it's out. So this is the guy. So when we can just go a little bit to see, it was around 700 or 800 years ago when he was able to discover the natural proportion of things, in the universe, or the natural proportions of the things in the universe. So you can see he was an Italian man from the Republic of Pisa, was the most talented mathematician. He is commonly known as Fibonacci. It was made up by this guy, and is short for Philas Bonacci. However, even earlier, so what did he do? He popularized the Hindu-Arabic numeral system in the Western world, primarily through his composition Liber Abaci. So it's also called the Book of Calculation. So this is pure math. So because of time, and I don't have enough time for you guys, but at least I'll be able to show you how these numbers work. So he introduced Europe to the sequence of Fibonacci numbers, which he used as an example of Liber Abaci. So what are Fibonacci numbers? Let's have a look. In the mathematics, the Fibonacci numbers, commonly denoted as Fn, form a sequence called the Fibonacci sequence, such that each number is the sum of the two preceding ones, starting from 0 and 1. So that's what the Fibonacci numbers are. And he was born around 1170 to this guy, to Guerrero, an Italian merchant and customs official. So I won't go much. I just wanted you to see him. At least some history is not bad. When, who, and then we move now to our course of the day. Or something else I want us to note is the golden ratio. So just a minute. There's something I need from Google. Golden ratio. Yeah, golden ratio in nature. So let's get started. So don't worry, divergence will take less than 5 minutes. So let's just concentrate mostly on Fibonacci, then the moving average, so that we have a concrete trading plan. So his is the guy. So he had an aha moment when he discovered a simple series of numbers that created ratios describing the natural, this is the most important thing, the natural proportions of things in the universe. That is to mean everything happens for a reason, or probably everything is connected to everything, even the universe, ourselves, the way we think. So this is what he was trying to come up with through numbers. So the ratios rise from the following numbers: 0, 1, 1, 2, and so forth. 0, 1, 1, 2, 3, 5, 8, like that. This series of numbers is derived by starting. So you need to have your calculator with you where you are. I hope you have your calc so that we do some math. So this series of numbers is derived by starting with 0 followed by 1 and then adding 0 plus 1 to get 1, the third number. So you can see these are the numbers. 0 plus 1 is 1. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. Then adding the second and third numbers to get the fourth number and so on. After the first few numbers in the sequence, if you measure the ratio of any number to the succeeding higher number, you get. So now I hope you have your calculator there. So if you measure the first few numbers in the sequence, if you measure the ratio of the any number to the succeeding number, you get 0.618. So for example, 34 divided by 55. 34 divided by 55, I think you get 0.618. 55 divided by 89, you get 0.618. 21 divided by 34, you also get 0.618, and so forth and so forth. So if you also measure the ratio of the alternate numbers, for example, 34 divided by 89. Now here we are moving 34 divided by 89. What do you get? You get 0.38. You also do 21 divided by 55, 0.38. You also do 13 divided by 34, 0.38. The same. So this is our most important numbers we'll be looking at, 0.618 and 0.382. Let's continue. And it looks like this. So what have you done? You have just experienced a Fibonacci sequence. So it is formed by taking two numbers and adding them together to form that number. Then the second numbers are added again to form the fourth number. I think that is very clear. So this ratio can be found in many natural objects. So this ratio is called the golden ratio. We call it the golden ratio. And I'll be showing you how it looks like. So you always see a pattern that looks like a spiral. And also the ratio, or the golden ratio, is actually an irrational number like pi, and is often denoted by the Greek letter pi, or something that looks like this. So now let's go to the real thing. These are the levels we'll be looking at in our trading. We have Fibonacci retracement levels and extension levels, 0.23, 0.38, 0.61, 0.76. 0.0 will be our first, 0, then 0.382, 0.618. You can see these two have been repeated, both on retracement and extension. It's because they are very key in our trading. So don't worry about all that. Your charting software will do all the work for you. So however, it's good to be familiar with the basic theory, so behind the indicator, so you'll have the knowledge, of course, to impress your date. So what we'll be doing, welcome Florence, traders use Fibonacci retracement levels as important support and resistance. Remember last time we did oscillators, overbought and oversold, but today we are going to combine that with Fibonacci to get our support and resistance within the trend. So there's a trend already moving. We need our temporary support and resistance to enter, take profit, or get out. Then now divergence will be showing us those reversals. So what are we doing? Traders use these extension levels as profit-taking levels. So today it's all about taking profit. When do we get out? So this is where now I'll be showing you where we are getting out. So since so many people so many traders are watching these levels to place buy and sell orders to take profits, this tool tends to work more often, not due to self-fulfilling expectations. So first of all, you have to identify a swing high and a swing low. So a swing high is a candlestick with at least two lower highs on both the left and right. A swing low is a candlestick with two higher lows. So higher low, then a low, higher, then another high. So that's what we are looking at. So how do you use the retracements? Let's look at how we use the retracement. Before we go that, let's have a look at I wanted to show you the golden ratio in nature. So I'm just going to go to Google, and this is the golden ratio. It's usually all over, everywhere you'll see. So I just wanted to show you. So you can see like the rose flower, you can see the spiral, kauri flower, you can see this is the Fibonacci sequence. It starts like this, then comes like this, then comes like this. You can see it here. You can see it in Milky Way. You can even your face, from the nose, even the eyes. The shell, look at the shell. I hope you can see the shell. So the shell also, the way the shell is done, this is Fibonacci. You can also see the flower, even the wormhole. You know about wormholes, the same thing. Flowers, egg. You can see golden ratio. This is the golden ratio in nature. Even the sun, as it rises. There's so many other places I can show you. All these, Mona Lisa's face. Your thumb, look at your thumb. Your thumb also forms a kind of Fibonacci sequence. So what else do we look at? So many things. This is you can see the golden ratio everywhere. Anywhere you're seeing a spiral, the water. When the water is kind of forming within somewhere there's a hole, this is Fibonacci, and so forth and so forth. So even the stairs, I think you have seen some buildings which have a spiral, such as this one. So I believe this is okay. And then the eyes also, and so forth and so forth. The ear, even your ear, from here, going like this, this is the Fibonacci. So iPhone, welcome. Then who else? I think this is okay. Yeah. Most of this. So just check Google, just write golden ratio in nature. Then you're going to see what mostly I'm talking about. So for today, let me just go to the retracement level. So let's continue. So how are we using this through our trading? So Fibonacci retracement levels are horizontal lines that indicate the possible support and resistance levels where price could potentially reverse in direction. The first thing you should know about the Fibonacci tool is that it works best when the market is trending. So we are looking at a trending market like this one. Let me show you. So this is a trending market. You can see it fell down. There was a big spike. Then it started going up. So this is the kind of market I'm looking at. And I can even go back. You can see it's trending because you can see there seems to be something like a wave. If I zoom out completely, look at my gold. This is now my gold. This is a trending, very good trending market. So let's continue. So we are looking at a trending market. The idea is to go long. Going long means we are buying. Like here, you buy. When you click new order, you will see sell or buy. So when the market is going up, you should be buying by the market. When the market is falling, you should be selling by the market. So let me finish, then we go to the practicals. So just give me a few. So and go short or sell on a retracement at a Fibonacci resistance when the market is trending down. So Fibonacci retracements are considered predictive. So we are looking at predictive technical behavior that attempt to identify where the price may be in future. So right now we are looking at where this price might be. So I'll go zoom in, yes, around there, so that we can be able to see we are at 1790, where this price might be going in future. The theory is that after price begins a new trend direction, the price will retrace or return pathway back to a previous price level before resuming in the original direction. And that is very true. You can see it immediately fell, then it started resuming in the original direction. So we are still ranging around this area, and we'll be seeing what's happening. So in order to find these retracement levels, you have to look at swing highs and swing lows. So let me get a chart like this one, or let me draw on this one. This is the swing high, this is the swing low. So you get your Fibonacci, then you drag it swing high, and then up to swing low. So and you can also move it all the way to this side. So you can see that's your swing high and swing low. This is USD/SGD, the Singapore pair. So I'm just showing you with a plain chart. Then around here, you should find around 76 points. So we are looking at 176.3, 61, 50, 38.3, 28, and 0. And that's how our market looks like on this pair. So let's continue. So uptrend, you can see swing high, swing low. So we are looking at this level. So this is an example. You can see there was a lot of consolidation around the 38. So the idea with Fibonacci is to look at the previous trend, number one. So this was consolidation. So you can see there was no trend, but you can see there was spike, 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 and spike. So now here 38.2 was acting as our support. So that's an example. And then this is another example. You can see it was going down. Now 50 was acting as our resistance. And you can see price was trying to go up, but then the bulls were overwhelmed by the sellers or the bears, and the price had to fall down. Fibonacci is very, very, very important. So what are we doing? One thing you should take note of is that price won't always bounce from these levels. They should be noted as areas of interest, or we call them kill zones, whereby we are looking at any potential breakout up or down. For now, there's something you should always remember about using the Fibonacci tool, and it's that they are not always simple to use. So also they are not foolproof. What does that mean? Let's have a look. So this is to mean they are not foolproof. That is to mean just because someone is looking at this level, it cannot be. So like this is another example, you can see. So here some guys would be selling, but you see the price broke up and continued rallying up. So let's keep going. So you can use them with support and resistance, like what I've drawn here on gold. So this is my support. You can see this line. So let's do the practical. 1784 becomes my support, and then up here becomes my resistance. And then I've also drawn a trend line so that I form something that looks like a wedge. And then now I've drawn my fibs. You can see it's just above 61. So let me finish on theory, then I go to practical. You are here. So you can use them with support and resistance. So I'll just show you how to use them. I think my internet is a bit slow. Oh, it's back. So you can see this was moving up. So this was my support. So what are we looking at? We are looking at a point whereby we have a confluence. Where is that picture? Or here. So you can see 1, 2, 3. So for you to identify a strong support and resistance, we said with the last class, you have to look at how much times it has been retested. You can see here it was retested because now here it was our resistance. But then when the market went up and came back down, retested, came back up, down. Now this line became our support. But when it was here, it was our resistance. It was until it was broken is when now we had support. So now it was retested 1, 2, 3. So now it becomes strong resistance. And you can see it's within the 50 mark. Then, of course, there was a big breakout going up on the upside. So now what am I doing? I'm showing you how to use fibs with support and resistance. You can also combine it also with trend lines. So trend lines are amazing. I've been coming to love them just the way I love moving averages, because trend lines, you just need to know which one was broken, like this one. You can see where I am right now on gold. Look, this is 1, 2, 3, 4. So now gold just needs to break this line. If it breaks this line, we are going up. If it's breaking this line going down, we are going down. But because we are within the 50 mark, most likely, and there's too much also consolidation, I don't see a way of how this price may come down, because you can see we have too much. 1, 2, 3, 4, almost 4 or 5 retests. And you can see here there was also a lot of strong support. So now here 61 will be acting as our support. So let me finish, then I'll show you practically. So let's be done. This is a trend line, you can see. Because how do you identify a trend line? There's a slope, something that looks like a slope, because the price goes up, bounces, goes up, bounces, bounces. So somehow within the trend line. So now here we are looking at 50. Where did the market bounce at? So I'll be showing you another one more example, then we are done. So I think this is okay. So let's do divergence now. No, before we do divergence, yeah, let's do divergence so that I finish up with Fibonacci. Yeah, so let's go to divergence. So for fibs, before I go to divergence, I'll just show you with gold. Price has to have swing high and swing low. So now this line here, 1835 on gold, becomes a strong support, because you can see it was tested here, it was tested here, it was tested here 3 times, and now it was tested here 4 times. So now when I'm drawing my fibs, I'm drawing it up to there, because now price has not decided to go back up there. So around that 1835 is where we are looking at. So trend line, at least you can see, you can draw them. Then I think there's also another, can you see another trend line? Let me go to silver. Yeah, trend line, you just get it this way. So this is how you draw a trend line, up to around there. So all you look, so now what I'm doing, I'm also showing you with silver. So this is how you draw the trend line up to there. So that's where silver is. Then I'm going to draw my support and resistance. So give me a minute. Sorry. So that's the red line 24 becomes my resistance, and then this becomes my support. So I'm going to draw 2. Yeah, so that at least we see this zone. Then I'm going to zoom in so that you can see that looks like a triangle. You see what I was talking about. So when I zoom out a little bit, you can see there was more than enough support, because you can see there was a spike here. There was another spike here. So this is 1, 2, 3, 4, 5, around 5. So this is a very strong support. Then you can see my RSI is about to cross up 50. So for us to get our trade here, if we are going to go long, we just need to wait for this RSI to cross here. And we also need to wait for the price. Let me zoom in. We just need this price to break this trend line. Once it breaks now this trend line, we can put our take profit here, or we can put our take profit around 50. So For Fibs, I won't touch them much because of our time, but I wanted just you to know you're looking at support and resistance. You can also trade them with the candlestick. I sent you so much material on candlestick. So we are only looking at the breakout. So if we are doing the stop loss and we are to get in, of course, we have to put our stop loss maybe just below here, because this was our last point whereby the price was retested and was rejected. If we are doing take profit, we are looking to put our take profit maybe around here. You can see it's just below 50 was where our last stronger resistance was, because it was tested 1, 2, this is 1, 2, and 3, 4, 5, 6. Yeah, so you can put maybe your take profit here if you are day trading. If you are swinging, of course, maybe you can put your take profit around there. If it breaks, you can do take profit 1, 2, even 3, even 4, depending with, of course, the fundamentals. So I think for Nini is good. For, what do you call it? Fibonacci is okay. So let's touch a little bit on divergence for our class. So what I wanted to show you also is with the moving average. You can see the moving average on H1. Let's go to H1. Then I zoom out. You can see anytime the moving average are crossing, there was a big sell. Anytime they cross above, there'll be a big buy. So if I also zoom out, you can see, and I go back, you can see also here when they crossed, there was a very good wave whereby we were really moving up. Not very up, one straight line, but like a wavy line. So for moving average, most likely I'm using 14 and I'm using 20 SMA and 14. I'm using also SMA. If I have to use 5, I can add 5 on my chart. For day traders and scalpers, I can come here and add 5 using maybe yellow, but 5 I'll use exponential. The reason why I'll be using exponential is because I want to track the current price action. So, and then I'll maybe use M30 or even M15. So that now you can see the yellow line. Anytime the candles are below the yellow line, we are selling. Anytime the candles are above the yellow line, we are buying. But I want you to know, for the moving average, the exponential, this one is for people who want to get in and get out fast, even with M5. But I won't go beyond M5. I'll just go beyond M30 and maybe H1. So even H4 works okay. But for the yellow, let me not use it today, because I'm mostly looking at the trend. So let's just, so that we don't complicate our chart, let's just use 14.
Unakumbuka your password?
Sorry. So let's continue. So I'm looking at the reversals. Can you see these reversals? And this is where now divergence will be coming in. Let me touch on divergence. Then we combine them with the moving average and the oscillator. So what if there was a low risk to sell near the top or buy near the bottom of a trend? What if you're already in a long position and you could know ahead of the time the perfect place to exit? So also combining with Fibs and divergence is also getting our profit. Instead of watching your unrealized gains, aka your potential Aston Martin down payment, okay, vanish before your eyes. So what if you believe a currency will continue to fall, but you'd like to short a better price? So when we are using divergence, a trend is falling, we need to keep selling, or a trend is buying, we need to keep buying, or a trend is about to reverse. We need to know that. So this is what now we are talking about divergence. It's called divergence trading. So in a nutshell, divergence can be seen by comparing price action and the movement of an indicator. So this is our price action, and then our oscillator, or the movement of the indicator, is down there. Now we are talking of something like our RSI down here. You can see this is now the indicator. Let me put it just that way. So let's continue. So it doesn't really matter what you can use. So you can use RSI, MACD, or you can also use stochastic or CCI. So these are the four oscillators mostly I use, but RSI, MACD, stochastic, or CCI. So on my chart here, maybe we can use which? We can use RSI, MACD, or stochastic and CCI. So let me add down here, we add stochastic. So the default settings remain the same. It's 20 and 80 overbought and oversold. Then that is gold. Then on silver, I'll add now CCI and MACD. So let me first add MACD. Everything else remains the same. looks like that. So that's my MACD. And then, so let me just use RSI MACD and RSI stochastic. Let me not touch on CCI because CCI, I'll touch it on the next time. Hope you all will be around so that I guide you, or I can also add it on SGD here. So that at least I just show you how it works. Then we can call it a day on divergence. So I think that's okay. So that's my CCI on H1. This is H1. So I think this is a trending market, a very good one. So I can even use the line chart. So then I zoom out a little bit like that. So I think that's okay. So let's finish on divergence. So I've added RSI MACD. I've also added RSI stochastic, and I've also added CCI on my USD SGD. SGD is Singapore dollar. Singapore does very well economically. So that's why I've paired it with the dollar. So the great thing about divergence is that you can use them as a leading indicator. And after some practice, it's not too difficult to spot. When traded properly, you can be profitable with divergences. So we want to make as much profit as possible. So the best thing about divergences is that you're usually buying near the bottom or selling near the top. This makes the risk of your trades very small relative to your potential. Okay, so we are looking at higher highs and lower lows. So if the price is making higher highs, the oscillator should be making higher highs. If the price is making lower lows, the oscillator should be making lower lows. If not, that means the price and the oscillator are diverging from each other. So let me show you an example. So this is the oscillator. So if the price is making higher highs, of course, the oscillator should be making higher highs. So, but now look at here. The price was making lower lows, but the what do you call it? The oscillator was making higher highs. So this was a divergence here. So around here, there was a divergence. We call this a regular divergence because what happened, it automatically did what? Changed the trend. So this is what we are looking at. Divergence is an awesome tool to have in your toolbox because divergence signals that something fishy is going on and that you should pay close attention. So using divergence trading can be useful spotting a weakening trend or a reversal in momentum. So we have regular and we have hidden. So let's just have a look within the next few minutes between regular and hidden divergence. So on regular divergence, it's used to post as a possible sign of a trend reversal, like this one. So this was a regular because you can see price was falling here. Here the price was falling, but here the oscillator was rising. So this becomes a regular divergence. I also have an indicator that shows you this reversal happening. So in case you need it, make sure you talk to me after class so that I can guide you to it. Just shows you an arrow here and it draws a line. Because now to draw a line up and a line down. So let's continue. So that's a regular divergence. So we have bullish and bearish regular divergence. So for bullish, if the price is making lower lows, so it's going down, but the oscillator is making higher lows. So the oscillator now is higher lows, higher than low from lower lows. Lower lows is down, then this other one is higher from high to low. So that's what now we are looking at, regular bullish divergence. This usually, it looks like this. This is our lower low. Look from here, then this is our higher low. If you see this kind of scenario, now this becomes our regular bullish divergence. So the opposite is the bearish. So for the bearish, if the price is making higher high, but the oscillator is making lower high. So this one looks like this, higher high. So the price is moving up, but now when you look at the oscillator, maybe the RSI stochastic, it will show like a wave. That means you look at this high, this high and this should become lower than this. So this becomes a lower high. So this now becomes a regular bearish divergence. So as you can see from the images above, the regular divergence is best when used when trying to pick tops and bottoms. You are looking at an area where the price will stop and reverse. So the oscillator signals us that momentum is starting to shift, even though the price has made a higher or lower low, chances are that it will be sustained. We also have another one called the hidden divergence. This one is usually within the trend. It's called a hidden divergence. So this one has been occurring, especially the last 2-3 months, because markets have been really rising. Prices have been too high because of demand. Demand is quite high. So let's look at hidden divergence. Divergence not only signal potential reversal, but can also be used as a possible sign of a trend continuation. That means the trend continues. It looks like something like this. Always remember the trend is your friend. So what's that bullish divergence? It looks like this. So this can be seen when the pair is on an uptrend. Once price makes a higher low, look and see the oscillator does the same. If it doesn't and makes a lower low, then we have got some kind of hidden divergence. So this is our higher, high low. So this is, you will see as the price was down, then it's going up. But if the oscillator seems to be going the opposite direction, this is a lower low, now this becomes a hidden. So this most likely was a normal bullish trend, and it's a continuing bullish trend. Then bearish is the same. This occurs when price makes a lower high, but the oscillator is making a higher high. So you can see the price is making a lower high, lower then high, but then the oscillator seems to be going above. So this signals, of course, a hidden bearish divergence. So I think that's all for divergences. How do you trade them? Let me just give you the rules for trading divergence. Then I think we can call it time. So let's go to the cheat sheet. Okay, the rules. So this is a downtrend. So always look at, can you see higher lows, lower lows, higher lows. So most likely here there might be a reversal. So in exactly, let's see what happened. Sorry, my internet kind of is slow. Yeah, and you can see exactly what happened. And you can see it even broke the trend line. So you can notice also there was tweezer bottom. So always remember, candlesticks, you'll never do without them. So that's why there was a regular bearish, bullish divergence there. Keep an eye out for other clues that the reversal is in place. So how do you trade a hidden divergence? The same. Can you see this is a hidden divergence? Goes up, then you can see it was making higher. This was higher highs, and this was lower highs. So this was a regular bearish, hidden bearish divergence. So let's go to the rules, because I think that's okay for today, or how to avoid entering early. So let's see how you avoid entering early. So when you're using divergence, you have to pay close attention to the oscillators. Let's have a look. You'll end up with a divergence between your mind and your wallet regarding your wealth. So wait for an indicator crossover. This is very, very important. So when's the crossover? This crossover. So always look at especially stochastic. So here I'll be using silver. No, I'll be using gold. You can see stochastic. This is what I'm talking about. So let's use H1. So this was another, can you see? The price was making higher highs. High highs, and the oscillator was making lower lows. So, but then now this is too much consolidation. That's why I'm saying for gold, I don't think it can be able to go down now, because now where it is quite fixed, because you can see also the triangle, and it seems to be breaking part of this triangle. So we just wait for gold, no hurry. So let's look. So wait for the crossover. So then patience is a virtue. Then let's go to the, what else do you look? Wait for an indicator to move out of overbought or oversold territory. So these now are the momentum indicators. So like here, we are waiting. Can you see here? It did not leave. So it went up, then came back down. So there you have been burnt out. So look here, there's a break. You can even draw that trend line here and draw another trend line here. So this was the break. So of course your entry was around here going long. So let's go to the rules now, then we call it a day. So less than a minute. So on divergences are used by traders in an attempt to determine if a trend is getting weaker, which may lead to a trend reversal or continuation. Make sure your glasses are clean, higher high than previous high, lower low than the previous low. Also check out for the double bottom and double tops. That's very important. Then draw lines on success. I have shown you how to draw them. So I think that's okay. Connect the tops and bottoms, and then from there, of course, get your trade. So divergence, I have an indicator. So in case you're a client, you're trading live, you can talk to me. So also make sure there's an alignment, vertical alignment. Can you see